afternoon, everybody. I'd like to welcome you all to the halftime talk, where we every week have a featured guest to talk to us about all things energy, oil and gas, and where the trends are going globally today, outlook for the markets, and looking at both of the regional picture and widening out a bit to any macro factors that could be impacting that. And I'm delighted today to be joined by Mr. Chris Wood, who is the CEO of RAKGAS LLC here in the UAE. Welcome, and thanks so much for joining us, Chris.
Thank you very much for having me. It's good to be here this afternoon and to join Gulf Intelligence again on what is clearly a very hot topic at the moment, which is energy, all things energy transition, and clearly security.
Absolutely. Clearly all within the backdrop of so many things, not least of which is the war in Russia, Ukraine, which some arguing there may be light beginning to appear at the end of the tunnel, but on the ground, really not much changing. Chris, let's start to talk a bit about sort of gas markets and prices. Let's look at the global picture. Obviously, it's been a pretty volatile year for commodities in general, for oil and for gas. Prices peaking earlier this year, but arguably calming down a little bit, in the last couple of months. Where do you see that going? What's the feeling of the market as we end Q4 and into Q1 in terms of, will we continue to possibly see this relatively more stable gas market?
I think stable is all relative at the moment. I remember the days when a 10-cent swing in oil price on a day was a massive swing. And then we moved to $1 was a big swing, and now we're talking tens of dollars is sort of acceptable swing in a day. And the volatility the market is absorbing to some extent. So it's interesting to see how over the years we've adapted to such big swings, and we have better tools, better systems for it. But if you look at where we're going for the foreseeable future, clearly there's a couple of big drivers that are going to push gas and oil prices over the coming quarters. That is the ongoing conflict in Ukraine and the ramifications around sanctions and embargoes around Russian oil and gas products. And the rebalancing of the supply chains associated with that. I think what we're seeing and what has been the most dramatic effect is those supply chains on the energy sector, but not just the energy sector, in other sectors as well, and flow on, is how those supply chains and the infrastructure to deal with those supply chain changes are having an effect, not just in Europe, but also Middle East. Clearly there's been a bumper demand from Middle East products, and clearly in Asia, as a large consumers, they're feeling the effect of the sort of pivoting away from Asia as being the big demand center, or the main demand center, to Europe being the main demand center, being the global price setter as such. Is that going to change? I don't know. I think the big question is, what will happen if things do start to improve and peace talks happen in the Ukraine conflict? Okay. But also, also China. But we'll come on to China, I'm sure.
Exactly. I mean, let's talk a bit about Asia and China. And you mentioned how a lot of the gas supply that traditionally would have gone to Asia has pivoted to Europe because Europe can pay more for it, and we've had a restrictive gas supply for a lot of this year. That's obviously had a big impact on the poorer Asian nations, namely Bangladesh, etc., Pakistan, who are highly reliant on that gas and are not being able to compete, let's say, with Europe. Let's talk about China, though, and where you see that going. A lot in the news again this week, again, the market's rallying on the fact that, oh, China's finally maybe opening. But what is the outlook for it as a consumer going into next quarter? From your point of view, it's had a pretty quiet year. More of the same in 2023?
It all depends on the government's appetite for opening up with COVID and how their current COVID measures are taking effect to dampen down the spread of COVID in China. Clearly, we had the initial exuberation of where we saw China looking to open up, and people thought they were going to open up, and clearly the government turned around and said, no, we're continuing to hold zero tolerance policy, and therefore will remain shut down. And that over the last year has led to a massive reduction in gas and oil demand. I think gas, we're over 20, almost 30% in some months below off the beginning of the year, the opening of the year. I think we're somewhere in the region of 8 million tons, and they're down to 5 million-ish. So I think that has had a big impact, and it was clearly had a big benefit for Europe, because if China was at full swing and was that 20% was being absorbed by China, then the prices globally we would see much higher. But I think, as you said, the impact, the impact around that for the likes of Pakistan, Bangladesh, who don't have the deep pockets of Europe to subsidize energy prices and also pay the higher prices, means that those big demand centers have been left out in the cold. And the other day, Pakistan put out to tender some contracts for LNG and got no bidders, which is amazing, considering a couple of years ago where we were awash with LNG. Now suddenly we're short, and a big demand center like Pakistan is struggling to get interest at current market rates, it shows you how dynamic and how opportunistic and the rebalancing of supply chain has happened.
Yeah, absolutely. And the flows that have changed direction. I mean, let's talk a little bit about Europe, which has been importing more gas from the region, taking that share away from Asia. Everyone has calmed down a bit about, this particular winter, that we've got, Europe storage is full, mild winter so far, et cetera, et cetera. No one anymore is saying, oh my God, we're going to have a squeeze, let's say, going into even January, February. And the main thing is next year, and this whole talk about that the infrastructure just isn't there to absorb more storage, even if we can get it. Tell us a bit about how concerning that is. Can Europe infrastructurally get its act together before next summer, with the outlook that there's going to be less Russian gas flowing there?
I think the biggest impact for Europe is, and this is something that I'm watching closely, is yes, storage is full, and it's higher than its 5-year average, but that storage was always incremental capacity to manage spikes, to manage extra demands, and you always had Nord Stream 1 flowing gas every single day. Clearly today, Nord Stream 1 is not flowing gas, nor is Nord Stream 2. Both have big holes in them, and there is no patching up happening of those pipelines. And there's no, I was talking to someone earlier, what do they think about Nord Stream 1, let alone Nord Stream 2, whether they will fix that. And they said it's pointless, even if the Russians fix it, I don't think we'll ever see gas flow through those pipelines ever again. And I thought that's a bold statement coming from a gas buyer. So that sets a very big challenge for the European countries to build infrastructure. Now their storage is full. There are ships offshore waiting to unload and have capacity, but can they inject that capacity into the system quick enough if there's a cold spike? And so I think you might see a couple of volatile weeks, maybe days through winter, where we do have some areas where the system is going to be tested. And clearly the role of trade is to try and get gas to where it's most needed, i.e. where the price is the highest. And so we will see that there's going to be some jumps and some spikes. If it's a mild winter, then great for Europe and great for, to be honest, great for the world economy, because that means prices will remain lower and volumes may flow to Pakistan, India, and elsewhere in Asia to balance out systems. But the long-term objective of Europe to pivot away from Russian gas and build the infrastructure, I think they're well on their way. You've seen some big projects that when they were first mooted, we're talking about 2028, then they were shelved, and then suddenly they can build them in 2026 and 2025. So I think where there's a desire and there's a political will, they can build the infrastructure in time. Maybe a few bumps on the way, I think.
Okay, and just, I mean, keeping a sort of European global picture, then I'd like to get on to the region here. In terms of price cap that's being discussed and proposed, the oil price cap, on Russian oil, and gas price cap, which is more of a sort of a European initiative. You know, a lot of people are dismissing both of them as sort of self-destructive, if you like. They're going to do exactly the opposite of what Europe needs right now, which is, you know, it doesn't want to prompt a shortage in supply, and therefore, you know, higher prices. I mean, where is that going, in your opinion? Should Europe be focusing on other things?
I am always against putting price caps, and you saw what happened to the UK when they tried to put a price cap in for domestic consumption. It sent a whole bunch of smaller retailers out of the business and bankrupt because of that price cap. It's great for the consumers, but I think there are better ways to benefit the consumers and help them through energy crisis. I don't believe that putting a price cap on European commodities will be any benefit, because as you alluded to, there is it'll then flow back to other areas that are willing to pay more. And that's the nature of the game of a free market, free global market. And while we have global indices, so it will flow to where someone's going to pay more, and therefore you might find that Europe is short again. So it might have a cheaper gas price, but not necessarily the molecules to back it up. So I'm not a proponent of price caps, if I'm honest. And I think the Europe does need to look at other ways to manage its exposure to not just price, but molecule availability. Which
is certainly doing and playing catch up. Let's talk a little bit about you know, the Middle East and a bit about RAKGAS and what you're doing, and just in general putting it in the context of investment into upstream oil and gas, which is, you know, generally speaking across the board taken a hit, and even with these higher prices we've seen this year, and a lot of oil and gas companies making lots of money, we're not really seeing evidence yet of how that's being invested back into supply. Tell us a bit about your operations here in the UAE, and more importantly, maybe into East Africa, which is a huge market, and where you see that potential.
Yes, so energy companies generally are being bashed a bit around about looking at investment in replacement barrels, replacement gas. Yeah, understandably for us, we've been a bit sort of apprehensive with the agenda around climate change, and the fact that the sooner we get out of using hydrocarbons, the better. So it makes us a bit, or makes the energy industry a bit nervous about the long-term investments. And we have RAKGAS, we have been plowing on ahead regardless, and we have, in the first time in 16 years, we have new exploration activities. We've got our partners, we're working with ENI on our offshore A block, which they're planning to drill in December, and it's looking very promising based on the current data. We will know more at the end of Q1 of where we sit with that specific exploration well. And then we have PGING, or Orlen, as they've just been merged, and they're drilling onshore in December as well, and a very exciting block that they're drilling on. With us also looking at 2 more blocks that ENI have the option to extend into, and I'm hoping and expecting them to come any day now with the good news of they will move forward on that block. And then we are currently carrying out new seismic work in block 6, which is again aligned to some of the fields that we've discovered in our other blocks, and also in Sharjah that have been successfully recently. So it's quite an exciting time for us domestically in Ras Al Khaimah, because 16 years of no exploration. We shut in the Atlantis field in January, so production in our plant has gone into mothball at the moment, to now having to rush around and have drilling activity, exploration activity, and even having potential gas flowing the back end of next year. So moving forward, having very aggressive partners, very competent partners to work with us here in Ras Al Khaimah and RAKGAS to explore those domestic opportunities.
And you mentioned, I mean, sorry to interrupt you. You mentioned, that oil and gas companies generally are having this not dilemma, but trying to sort of remain in the equation of providing energy security, let's say, versus the sort of climate mitigation pressures that all companies are under, particularly oil and gas companies. And importantly, just looking at their bottom line, whether they should make those investments medium, long term, if they're just going to be shut down by new policies, why should they be making those investments? And that's been sort of the argument. And in tandem, of course, a lot of the big players have been investing in sustainable energy, cleaner energy, whether it's more gas or newer fuels. How should companies continue to tackle that dilemma going forward, do you think? We're just having a COP27 as we speak, still taking place in Egypt, where the industry is supposedly not welcome, but they need to be very much part of the conversation, don't they?
Absolutely. Post COP26, I think a lot of the energy companies sort of backed away, shied away, particularly the IOCs, around investing. There was a lot of shareholder pressure, a lot of NGO pressure to no longer drill, no longer explore, no longer extract. And if you think about, I look at our economics for our blocks in East Africa, the offshore is anywhere between $40 and $60 million a well. The onshore is $20 to $40 million per well. Those wells can be dry. It could be nothing there, because it's not a foregone conclusion. We drill a hole, we strike oil, we strike gas. The seismic will give us an indication, but based on the geology, then we start to fine tune. And you could have a number of unsuccessful wells before you hit success. And in our industry, that is a lot of cash that's sunk for an opportunity that then has to be developed and can take 3 to 6 years to be developed. And in fact, our offshore East African is 2032 when we're looking at production out of Zanzibar offshore. And if we're looking at that sort of time frame, and then we're having 2030 goals, 2040 goals that say zero hydrocarbons, then why do we want to spend that money when we can actually go and spend it in renewables, where we have things like the IRA policy in the US that will help fund and sort of fast track investments that have quicker returns.
Yeah.
And those are the sort of challenges that are sort of that have been dealt with since COP26. I think COP27 was a bit of an eye-opener off the back of the energy security conversations that have happened post Ukraine and Russia conflict around, well, actually we are in the transition, and we are having to consider that we're not going to get there tomorrow as much as we'd like to. So we are going to need hydrocarbons as fuel source for a period of time, and we'll look for better fuels, but also as feedstocks to build more efficient equipment, cars, wind turbines, solar panels, and so forth. So there is not enough bio feedstock to replace the chemical mix that we have today. So that still has to come from hydrocarbons. And I think the narrative that we saw coming out of both ADIPEC and COP27 and leading into COP28 here in the UAE, I think it's being picked up a bit more by the NOC, saying, look, people, look, we're here, we need to support a sustainable transition. And that means not a rush to the door and leave everything behind, but we need to be continuing to invest in hydrocarbons in a responsible manner, in a low cost, low carbon manner. That means that we have a sustainable and managed transition process. And I think that's the most important thing for us now, is how do we make our operations a lot more energy, a lot less energy intensive, should I say, and a lot less CO2 intensive, whilst at the same time contributing to that security and the growth that we see in the economies.
Yeah, I mean, on the efficiency side, so making our operations and our industries more energy efficient. I mean, we were attending a forum recently and had a conversation that one conclusion that came out of the round table was that the lowest lying fruits of energy efficiency aren't even, i.e. by the users of the energy, aren't even being implemented nearly to the extent that they can be, putting aside using cleaner energy. Why do you think that might be, that, industrial users, even personal buildings, etc., What is it that is not pushing that energy efficiency angle fast enough?
My view on that one is, it's like looking at a wall and you just see a brick wall and you can't see the opportunities. But if you stop and look at the individual bricks, you then start to see how the brick wall is made. And therefore, I think what we need to do is stop focusing on the brick wall as much. Still have it as the vision that we want to build something. I was about to say build a wall, but that's one's already been taken by someone else. But in this case, I think we need to break it down a bit more and have a look at, well, what's the steps we need to do to get there? What are the building blocks to build that wall that is required? Because it's not the sort of biggest project should be funded. It's looking at all of those. And we, with RAKGAS, we're working with our customers to decarbonize, not decarbonize, but reduce the CO2 emissions. And we've taken out in Russell Cameron, we've taken out 1 million tons by working with our customers this year alone, by moving away from other fossil fuels to a lower burning gas. And then we're working and looking at them with sort of, how do we then improve that going further? What do we need to invest in the short and medium term to support a sort of lower carbon fuel, lower carbon energy footprint for them? And I'd like to take that with us as we move into Africa and our assets in East Africa. How do we take those learnings, that knowledge into it? Not sort of forego the exploration and therefore boosting the economy and development of those kind of economies in Somaliland, where we operate, in Zanzibar, 2 countries that desperately need to see some inward investment beyond tourism and agriculture, but into building a broader economy. And I think if you just say, well, it's not going to include hydrocarbons, it only has to be renewable, then those economies are always going to struggle because they can't compete with the Chinas, the Europes, and the Americas for that space.
Hydrogen has been one of the big buzzwords in the last year or two as one of the cleaner solutions. Of course, using natural gas for blue hydrogen is the natural, most sort of organic solution, I suppose, that this region has, having plentiful gas. Whereas, again, a lot of investment needed there, a lot of scale. One criticism people make of the hydrogen burgeoning industry is that the technology is there, the solutions are sort of there, but we need to be investing more in scalable pilots, etc. Do you see that taking off in a bigger way in the next 5 years?
I see hydrogen having a significant part to play in decarbonizing and reducing the emissions from our energy mix. And I'm proud to say, living in the Middle East now, that the Middle East is from my point of view, is certainly leading the hydrogen agenda. You've got the UAE wanting to be playing 25% part in the global trade of hydrogen, which is a bold statement and a bold that's backed up by action. You've got ADNOC, Mubadala, Taka, all of those companies investing in a very, very big way to build hydrogen infrastructure off the back of our existing facilities. I think that's not the only solution. It's one of the many solutions. And I look at it as crossing a river. You can have your speedboats and you can get across very quickly, and you get to the other side and you've met your objective, but that costs a lot of money. You've got to build a raft, and you've got to, some people will swim, and it takes a bit longer. But to get across the river, there are going to be many solutions to get there, and not just one solution. And I think we need to keep our eye on the ball and saying, well, what are all those solutions? What are all the opportunities? While still maintaining the investment in R&D and capabilities. And one of the things in Russell Cameron is we partner with the university here, the American University, to develop the engineering capability and engineering students to look at new opportunities, to look at new ideas. And I think that's where a lot of companies are focusing as well, is what are the new opportunities that are going to come out of this next generation to identify. And I think it goes back to our conversation earlier around efficiency gains, if we can reduce the amount of energy we need, but also what are the new energy sources are we going to meet the new world for we energizing our communities, as we like to say here in RAKGAS.
Yeah, I'd like to touch on the point of just supply chain. We started the conversation, you mentioned that, and of course, you in your career have been in charge of a lot of supply chains across the industry, if you like. We obviously had the COVID challenge with physical supply chains, literally, and now that COVID is pretty much over, apart from in China in terms of policy or movement. Still a backlog of that, but how much is also the whole financial macro picture that the world is facing impacting investment into supply chain, into solutions for this sector? Are people taking a step back? Are they very nervous? How much is the current sort of macro financial environment, do you think, impacting future investment into solutions in the sector?
Very interesting question. I remember going back to my university days and studying just-in-time supply chains and looking at how we can have just-in-time and then the globalization and how that played into just-in-time. And I think of the recent upsets in supply chain, we can even point back to the ever given in the Suez Canal was the start of disruption of the current supply chain issues. You had that, then you had COVID coming on, then you've had the which has led to China pretty much slowing down and disrupting supply chains and the rest of the world. I think initially Italy is where we first felt it because we had a lot of pumps and valves coming out of Italy that just didn't come, and that was one of the first waves where we saw disruption out of the COVID crisis, and that then led into sort of further afield and still remains with China to some extent. And now we're having the economic slowdown globally, where we're seeing investments slow down, but we're also looking more at, or we're seeing more countries that are becoming focused on self-sufficiency. How do we protect our supply chains? How do we protect our economies? And I guess indeed, so, deglobalization, where you have, I think the Ukraine crisis has impacted that as well, because now what we thought were sort of givens, like with energy flows, and that's changed fundamentally as well. So you've had not just manufacturing supply chain disruptions, but you've got energy supply chain disruptions. And that's putting a bit of a break globally on sort of growth, and it's going to be interesting to watch China and see how, when it does start to open up, that it's opening up its manufacturing base into a world that's a lot slower, a bit more depressed, and not as heated as it was when we entered COVID. So that's going to be setting a few sort of investment decisions back a little bit, but clearly we're seeing a lot more investments in the energy sector. I can talk about my sector a lot more than I can others. I did note some of the changes in Bitcoin and the impact on the Bitcoins, but I'm not a Bitcoin trader, so I can't comment on that.
Don't go there.
But, yeah, let's not go there. Let's stick to energy because that's my area. But we're looking heavily at new investments. I know some of our partners are very excited about some investments they're looking at. So I think the energy sector is stepping up and looking at how it can bolster the energy security and sustainability and supply going forward. But I do see from our operational point of view, where we're looking at drilling activities, we're looking at bringing our plant out of mothball and upgrading it, and there's issues around steel, piping availability, engineering capacity. So that's going to have an impact on sort of some of those investments we're looking at. You even see some of the big majors actually looking to buy steel mills just to secure capacity for their drilling activities and upgrade the capacity. So
yeah, and of course, one of the actors who is, or not yet, but will be suffering from supply chain will be Russia, presumably, with the sanctions that have been piling on gradually and more to come, obviously, early next month. There's a lot of talk about, so far Russian oil has continued to flow, it's found new markets, no problem. It's obviously continued to produce the oil, more importantly. But that its own supply chain, nuts and bolts, etc., will be impacting its actual production, as we go into next year. Yes, maybe cutting off its supply anyway to Europe and other parts of the world, but not to Asia. So how much concern, as we wrap up, is there? How real is that concern that actually Russia will not even have the choice to pump more out because of lack of spare parts, etc.?
Having lived in a country that has been under sanctions and not for the right reasons, and that's the interesting thing, that what sanctions do to some countries is they start to find innovative ways and find different ways of doing it and start to build their own capability. I believe in the short term, Russia will be impacted, not access to technology, predominantly not access to equipment and supplies. However, they have a strong partnership with, or growing partnership with China, and China is a big manufacturing base. So I assume that they will be able to secure some capacity out of China. But I think the biggest challenge, and having gone through it myself for economy like Russia, is the brain drain that's happened. So a lot of Russians who have had the capability have got out for various reasons. And that will be the biggest impact going forward for Russia when they finally sit down and have peace talks and start to be welcomed back at some stage, if we can ever believe that, to the world stage. But is how do you get those people who have the expertise, the capability, the training back into the country to get it up and running? And that's going to be the biggest challenge. I think one day, hopefully, I'm being optimistic that things will settle down and peace will break out and things will be sorted out and deals will be done. But that's for a country that needs to rebuild, you need the people to be there to help rebuild.
Absolutely. And just to be on that point then, not just Russia, but the brain drain is one thing from a country, but generally the talent drain from this sector in general. And especially post-COVID, trying to even convince people to come back who were in it just 2 years ago. Still proving to be a big challenge, isn't it? Attracting the right talent into this, and particularly the talent that can then start to implement things on the new energy front and on all those skill sets that are needed on that front. Can the sector compete with other sectors like tech and new economy for the talent that it needs?
Well, in one of my previous companies that I worked with, INEOS, we had a strong campaign around trying to build engineering capability and supporting engineering. I'm pleased to say here at RAKGAS, we do the same thing. We actually have a foundation that we work with, the Kasami Foundation, where we actually bring people, the students from Zanzibar here to learn engineering and petroleum engineering, to go back and start to build their economies. But also we work with, as I mentioned earlier, the American University of Russell to build on their engineering students. And I think it's important that we don't forget that we need to be reinvesting in that next generation, building that capacity and building the capability. But I'm a strong believer that the old energy sector and the new energy sector are absolutely linked. We talk about CCUS. It's one and the same. It relies on the old energy sector, and it relies on well engineers. It relies on geologists to understand how we manage those storage banks of CO2, as well as then looking at, well, it's the sort of engineers that design fast rotating equipment. That are going to be needed for the new energy sector as well, and also for the old energy sector. So I think the two are linked, and the more we can have that conversation of saying, look, it's not one or the other. You can move between them and share knowledge, and that knowledge sharing, that skills and experience will give us the opportunity that both sectors will develop and evolve. And we mentioned efficiency earlier, and develop the efficiency side of it as well. So
of course, I think, and the cross-sector collaboration as well. Partnering up with actual technology companies such as Microsoft or even Google, AI, etc. All of that is crossing over into finding solutions for this particular sector. Chris Wood, CEO of RAKGAS, thanks so much for taking the time to be with us today and for joining us on Halftime Talk.
It's been an absolute pleasure and great to talk to you again.